Good evening, everybody. It's interesting. Yesterday at this time, I was scuba diving about 70 feet under, swimming through a school of about 100 7-foot-long tarpon, and then at the other end of it, I saw two 500-pound sea turtles going at it like newlyweds. So it's kind of a transition from that to, hey, let's talk about options. Although I was presented with two options, I guess, on that dive. And so what I wanted to talk about, though, is just, I started trading about, it's been like 22 years ago now. And I first started trading in options. It's always been kind of where I cut my teeth. I think it's been interesting because as we've progressed with our main site, Trade the Markets, it's always been more of a focus on commodities. And what had happened is over time is people were just kind of like asking, every once in a while you show us these option trades. We'd like to know more about options. It's like, okay. So what I wanted to talk about tonight is just kind of dive into this. And I want to see how many people right now actually actively trade stock options. Okay, and then how many people in here have never traded an option before, just out of curiosity? Okay, all right, that's fine. And yes?
I just need to fill this out and we're going to give away the master.
Oh, perfect, okay.
If they want to fill that out.
Okay, so we do have, if you see this little card on your seat, we do have, this is a 4-day live trading seminar. It's a DVD. It was $1,900 to attend this, and we did this back in Chicago in March, and it's a 4-day course that we recorded. We're going to be giving one of these away at the end of the talk, and it does talk a little bit about all the strategies that we do and things like that too. And we'll just do the drawing for this after the talk. Okay, so let's dive right into this. Now, what I'm not going to be doing, just for those of you that don't trade options, I'm not going to be spending any time explaining what options are because there's plenty of information out there. But I do want to talk about the strategies that I like that work, because literally there are hundreds of different strategies that are out there. What I have found is that a lot of times, especially brokers, they will teach strategies that actually encourage a lot of trading, legging in, legging out, adjusting and different tweaks and things like that in order to maximize commissions. Okay, and it's that's kind of their job. And a lot of the strategies are the net neutral, delta neutral. A lot of it's you'll have these iron condors, which are fine in some situations, but there'll be some trades that actually enable 8 trades to put on the trade. I actually don't think you need to be that complicated to do option trading. Okay, so I'm just going to focus on my 5 favorite styles of trading. But what I want to talk about first, and the first strategy I'm going to talk about is directional swing trades that last a couple of weeks. But before I dive into that, because I found that I've talked about this before, and the questions that I get afterwards, it led me to realize that maybe some people don't fully understand the importance of volatility in the markets. Okay, so we're going to dive into that real quick because this is a really important tool that'll let you know when you should be focusing on selling options or when you should be focusing on buying options. Okay. So when I talk about volatility, a lot of people misunderstand that because they think that, volatility, that's the VIX, right? I'm actually not talking about the VIX. What I'm talking about is the volatility of the individual stock that you're trading, whether it's a stock or it's an index, on the time zone, not the time zone. The time zone is what I'm dealing with right now. The time frame that you're trading, okay, whether that's a daily chart or an hourly chart, etc. Now, examples of these are the Bollinger Bands, Bollinger Percent B, the average true range, the ADX, and then also the one that we have developed called the TTM squeeze. All those together work really well. So why are these important? Well, when you have a low volatility environment, it's essentially a period of consensus regarding the fair value of an asset. And it's just, it's kind of a choppy market. Everybody's fine with where prices are right now. And during these periods of time, there is a specific strategy just called reversion to the mean type trading, which we'll talk about, that works really, really well. Okay, and it's something that you can do both directionally and as well selling credit spreads. So let's get a graphical interpretation of this because it's important to understand this. So what I'm talking about here is, now this happens to be a weekly chart, it could be an hourly chart, it could be a 5-minute chart, it doesn't matter. The signals that I'm talking about here in terms of a squeeze, okay, so here's a squeeze signal with the red dots, here's another squeeze signal with the red dots, and here's another one. Now, what this is if you don't know, all that represents is it's showing us that the Bollinger Bands have actually contracted to the point where they're almost trading horizontal to each other, okay? Most of the time, Bollinger Bands are kind of all over the place, but when they get really, really quiet, they get into what's called a volatility squeeze. And it's important to understand when this is taking place, because it will completely impact the choice of option trades that you do. And a lot of times when I talk to people, they'll talk about the option strategies that they tried that lost money, and they were doing them at a time when literally they shouldn't have been, kind of doing them. As an example on this, right here, say like an Apple, if you look at this and say, wow, Apple's been trading sideways here, I think I'm going to do an iron condor here. And if you place it here, your trade went completely against you. So what you're looking for here is two things. One, you're looking for a squeeze. The squeeze is telling you that volatility has gotten really, really low and it needs to release energy, okay? So here you can see a squeeze set up with an ADX of about 30, okay? And Apple had a nice move here. It wasn't fantastic, but it was nice. Here was another squeeze. At this point, when the squeeze started, the ADX was about 28, and when it released energy, it was another decent move. Here's where it all comes together. Here was a squeeze at the beginning of 2012 that had a very low ADX reading, okay? And this is what you're looking for. When you get the combination of a volatility squeeze with a very low ADX reading, the chances are very, very high that you're going to get a very explosive move in the underlying stock, okay? And what's nice about this, and a lot of options theory talks about, you don't need to worry about market direction. Hey, if you've got this, just sell some iron condors, you don't have to worry about it. And I really disagree with that, because if you get something like this that's showing you that not only is this about to release energy, but the way the momentum is going to the upside here, the chances are very high that it's going to be the upside, then you can start taking advantage of strategies that are more directionally based. Okay, and a lot of times you can hear about strategies that are market neutral, yada, yada, yada. Market neutral works great 10 months out of 12. And then typically the 2 months out of 12 that it doesn't work, you give back all your profits. So you feel good because you're making money most of the time, right? But then the times that you lose money, you give it all back. So it's like, so this is what I found. So the first thing is understanding this kind of a scenario right here. So basically during this is when I see times in the market where there is no squeeze developing, then that's great. I'm going to do types of strategies like selling iron condors. However, if it's something like this where you get a low ADX reading and a squeeze, this is where you want to actually step up and do some directional plays. And the directional plays are nice because they have very limited risk and unlimited reward and take advantage of these bigger moves. Okay? All right. Here's another example of price line. Same thing. Once you get that squeeze with very low volatility, it's typically you're going to see a very exponential move after that. Okay. So when volatility is high, it is better to sell options, credit spreads, iron condors, etc. When volatility is low, it is better to buy options. And I prefer deltas of at least 70, which I'll talk more about in a minute. And then the thing about it is when there's something like a volatility indicator like the squeeze, what it's telling you is that a market is switching. Okay, and that's the one part I see a lot of people don't get, but markets are either doing one of two things. They're either trending or they're oscillating. When you see a squeeze, a volatility squeeze like this, it's telling you that the market's about to switch. Okay, it's about to go from oscillating to trending. You have to understand that, because if you start doing oscillating strategies in a trending market, you're going to get killed, and vice versa. Okay, so you understand what kind of market it's about to switch to. It's easy to tell after the fact. Oh, wow, we've got a trend on our hand. Apple's gone from 450 to 650. Yes, that's a trend. But you want to know during the process when it's transitioning. Okay, and that's where the volatility indicators come into play. Okay, so let's look at an example of some directional play. So this happens to be MasterCard. This is one I like to trade quite a bit. Here's a squeeze here. It sets up. Remember, it's a compression. We're looking for this to release energy. And so on a trade like this, we're looking at deep in the money July options. So even though MasterCard is trading at 170, I'm actually looking to get the $155 calls. Okay. Now for those, if you've never traded options before, what will happen is you're going to look at an options chain. You're going to say, wow, I could buy the $180 calls for like $2. Okay, why do you want to buy the $155 calls? They're like $17. Well, the idea with this, and it just has to do with premium decay. Now, you could buy the $180 call options on MasterCard, and if MasterCard goes from 170 to 180, you'll lose all your money. Okay, you got the direction right. You bought a call option and you lost money. Okay, and that can be a frustrating thing. That's why I like to go further in the money, because what you're looking for on these situations is you're looking to capture the underlying move. With a delta 70 option, if the stock moves up $1, the option is going to move 70 cents. Now, don't get me wrong, there are times when out-of-the-money options are great. If you buy that 180 call and the stock goes from 170 to 200, you're going to make a killing. It's just that you're talking about a 10% chance of happening. So why risk your capital on something that has a 10% chance of happening? Okay? So different things like that. Okay, so on something like this, for a directional play, I like to use this signal to get in. We get in the trade. Now, there's two ways to do it. You can stay all in until it starts to lose momentum, and at that point, you can exit the trade. What I like to do is just scale out essentially every 1 standard deviation. So in this particular case, where'd it go? So I'll start off and say this option costs $16. So for a hard stop, I want to risk half the price of the option. Okay, so obviously you don't want to put your entire account into this one trade. If you want to say, well, I don't want to risk more than 5% of my account in any one trade, then great. You're going to put 10% of your buying power into a trade like this. If it gets stopped out, you've just lost 5% of your equity. Okay, or if it's 3%, you can adjust accordingly. So that's the stop loss. Now the first target is 50%, so for a third of it. So if it goes from $16 to $24, I'm going to take off, let's say I have 3 contracts, I'm going to take off 1 contract. Second target is 100%. So if it goes up to $32, I'm going to take off another third, right? And on that last piece, I'm just going to wait until we lose momentum. Now what may happen sometimes is it may lose momentum before then. Great, you just take off the entire position. But I'm willing to hold on to that, take off a third, another third, and then hold on until we get a loss of momentum to see if we can actually get one of those big kind of a fat tire events there. So in this particular case, if you held on to the end, you bought an option at 17 bucks, you sold it at 55, and you ended up with a profit of $3,800 per contract. Okay? Now in that same situation, you could have bought out of the money calls and actually lost all your investment. So that's why it's really important to know which ones to buy there. The other thing that I really like about this, now if you're a beginning options trader, this won't make much sense. Don't worry about it. If you have traded options for a while, you'll like this quite a bit. What I like to do with the squeeze too is because when there's a squeeze like this, it's telling you that there's a low volatility period in that stock right now. That's actually when you want to buy options. So you can see here, this is an indicator on TradeStation, implied volatility on all the options. The volatility here is very low. When the squeeze releases energy, not only does the price accelerate, but the implied volatility also accelerates. So you're getting a double whammy there. Not only are you getting intrinsic value of the option right there, but the implied volatility is increasing, and that's also increasing the premium portion of the option. Okay? So it's a really good strategy for buying options. You guys have always heard it's like, well, why would you want to buy options? 90% of the time they expire worthless. It's because people are buying the wrong options. But if you get a situation like this, where you get a low implied volatility situation, you've got a squeeze that's about to release energy, and you buy delta 70 options, that's how you can make money directionally. Okay? All right. So that was the first strategy. That was the longest one. The rest of them are shorter. Directional swings, trades that last a few days. Now, this is my favorite. This is probably of the 5 that I'm going to show you, this is my favorite. I find I've got a sleeping issue, and I find that I've got 3 young kids in the house. There's always one crying at night. But if I'm flat, like if I don't have any positions on, I cannot sleep. Okay, I don't know why. The kids can be crying. Like my wife gives me crap because there'll be 2 kids crying. She's running around the house. She's like, I'd love to have some help, and I will sleep through the whole thing, which is good for me, but it does mean in the morning that we're going to have a conversation. But what happens is literally if I don't have a position on during the evening, I do get a little antsy. I just can't, I want to wake up and just be a part of what's going on in the markets. And that's probably something where it's just enjoying the markets. I love the markets. I like what's going on. And I like to at least have some exposure overnight so I can wake up and, it's like life is like a box of chocolates. You never know what you're going to get. And this is a strategy for that because it's not something where I'm going to be in it for weeks. I'm literally looking to buy something on Tuesday and either sell it Wednesday or Thursday. Okay, and it's that meat of the move that you're trying to grasp. And you're not sitting in there, you're not having to stare at charts, you're not having to sit there and watch every tick, but you've got the potential for bigger swing type moves with a small time frame like that. Okay, so here's what we're looking at. This to me is a fantastic setup right here. Goldman Sachs is a stock I like to trade quite a bit. Now what I'm looking for here are hourly charts. Okay, these are signals I take off of the hourly chart. And I'm typically looking at, I've got the trend. You always want to have a trending indicator, an oscillating indicator, and a volatility indicator on your chart. Okay, one of those three. So my trending indicators on this are the waves. What these measure are the long, medium, and shorter term momentum on whatever market, whatever time frame that you're looking at. Volatility indicator here is the squeeze, of course. And what I'm looking for here is when a squeeze fires up like this, when I see these red dots, if the momentum here is lined up where it's all above zero, the chances are about 80% that this is going to trigger to the long side, and then that Goldman Sachs would then move to the upside. Okay? Now I'll show you another example here. On that same day, this was a chart of Amazon. Okay? And this triggered a short trade where in this case I'd buy a put. However, I didn't take this trade because it wasn't clean, because you had the longer term momentum above zero, which meant the longer term momentum was higher. Okay? And the cleanest trades like this are the ones when everything is just lined up. Otherwise, you're kind of fighting the prevailing trend. So this is an example of a trade that I would not take. And if we go back here to Goldman Sachs, this is to me almost like a textbook trade that I would just take over and over and over again. Now, this isn't the only piece of the puzzle, though. So when you find an hourly chart that looks like this, it's like fantastic, it's all coming together. The next thing you need to do is check the daily chart. Okay? Just make sure that you're trading in the same direction as the daily chart. Here, the daily chart is clearly in an uptrend. You've got the C wave above zero, the B's above zero, the A's above zero. You've got clean sailing ahead. And again, this is something I want to be trading on the path of least resistance. Yes?
I'm sorry, I may have missed it when you mentioned the three waves. What were those?
So the waves, they're similar to moving averages, MACDs and different things like that. But what they are is they're measuring both there's three of them. So the shorter term, medium term, and the longer term momentum on whatever market and whatever time frame you're looking at. Correct. Okay, so there's those. And okay, so now this is a directional play, so we've already talked about what kind of options we want to buy directionally. So in this case, I want to go in the money. I want to get a delta of at least 70. And if you're newer to options, that just means that you're going one or two strikes in the money. Okay. So if the stock is at 160, then you want to go down to like the 155 call or maybe the 150. In this case, the 155s had a delta of 68, which is close enough. So we pick those up. And then here's my rule of thumb with this. First of all, let's talk about targets first. What I'm looking for a move here is a specific percent move in the underlying stock. Okay? So what I'm looking for here is a 1.75% move in the underlying stock. And the reason I use percentage is because a $600 stock like Apple, a 1.75% moves is going to be a much bigger point value than a $20 stock. Okay? So you don't want to say, I want to make $1 and then get out. No. You get up 1.75% on the underlying stock, you dump half your position at whatever the market price is. Okay? So I'm very big on directional trades, on using the actual underlying stock to exit the trade. Okay, in this case, it's not so much like, wow, I bought the option at 7, I want to get out of it at 14. On this particular one, if the stock's up 1.75%, boom, get me out of half my position. The other thing you're not hearing me talk about here is I rarely, if ever, hold trades to expiration. That's another thing that always annoys me in books. They're like, oh, you buy this and hold it to expiration, or you sell this and hold it to expiration. There's nothing wrong with taking a profit before expiration, okay? And I'd be a little careful too about any strategies like that. One of the riskiest strategies that's taught out there, that's taught as a conservative strategies, is doing iron condors 2 weeks out to expiration. There's so many things that can go wrong with that. The best iron condors are actually done about 6 weeks before expiration and taken off about 2 weeks before expiration. But I mean, you hear, it gets very sexy the last 2 weeks of premium decay to do that, but that's actually the highest risk time to be in that trade. But that's another discussion. All right, so in this case, a 1.75% move, that means that's a move of $2.82 on the stock. If you've got a Delta 70 option, that means that option is going to move $1.97, give or take, okay, and you're going to get out of that trade. On this particular one, so you can see we bought calls at $7.20. Whoops, $7.25, $7.35, $7.40, and then flipped them out at $9.25, $9.25, and $9.05. So on these trades like this, again, you don't have to hit a home run in options trading. You don't have to buy something at 2 and then sell it at 10. You can make a living buying something at 7 and selling it at 9, okay? Kind of like Walmart. Except they buy it at 1 and sell it at 9. All right, so, all right, this is one of my favorite day trades. And I'm real big onto Fibonacci levels and Fibonacci extensions. I follow Carolyn Broden's work, if you've heard of her. But the 1272 extension is a very clean kind of a fib setup here. And all that is what you're doing is you're looking for a stock that's making a new high, okay? It doesn't have to be a new all-time high, just a new high for the day. Could be a new high for the year, a new high for the month. And once it pierces through, okay, then what you're going to do is you're going to take the Fibonacci's from this high to this low, and you're going to find out where the 1272 extension is. Because what I found is that if it breaks through to that new high, it's got about a 90% chance of hitting that 1272 extension, okay? So there's a lot of information that you can do with that. So here's an example of MasterCard. What's great about this is that, as you guys know, like if you try to do options plays, how many people have bought, say, options like on a stock like Apple the day before earnings? Just out of curiosity. Okay, well, at least 3 people had the guts to admit that they tried it. Okay. What happens a lot of time is that the implied volatility gets so high before earnings it's impossible to make money buying an option. Like an at-the-money option before earnings on Apple can be like $30. So you buy it, the stock jumps up $30, and you're break even on the trade. Okay? So it's, I mean, the system's rigged on that kind of stuff. However, after earnings, there's opportunity. So this is MasterCard after earnings. It popped up, made a good move higher, and then started to pull back. Well, again, what I found is, especially on these earnings plays, whether they pop up or pop down, is that if they make a high early in the session, at some point during the afternoon or the next day, they're going to break out that high, okay? Because they're going to take out all the people that were short. So what I like to do then is as it pops up here and pulls back, I then look for a squeeze. The squeeze is telling me it's like, hey, this thing's getting really quiet. It's starting to break out, get into a move. Great. I'll buy some in-the-money calls here with a stop at the low of the day, and my target is simply the 1272 extension. Now, what I'll do, though, is if the move happens very quickly, for example, if I'm holding it overnight and it hits that 1272 extension really quickly, I'll sell a portion of it and then see if we're going to get up to the 1618. Typically, I've seen it's about a 50-50 shot that it'll get up to the 1618. So in this particular case, and I actually like to use the TradeStation Matrix for options trading. I don't know how many people do that. They've actually recently come out with a lot of improved tools in their Options Pro, but I've always, for day trading, love using the Matrix. You can sit there, you can move your stops around. I think every time they move a stop around, doesn't that cost money though?
Well, there's a balance between orders canceled and contracts executed.
Some complicated formula like that.
Plenty of fine print, which I'll be glad to show.
Okay, I'll be sure to read it. So on something like this, then I remember this particular position closed. It was up like 30 cents or something like that. And then the next morning, it gapped up and moved to that 1272 extension right away. So that's great. I took off some of my contracts, okay, moved up my stop, and then I wanted to see if we're going to get to the 1618 extension. Now, what happened here is you can see it went up to the 1272 extension. Then it came back to its breakout point, and that's when things get a little dicey. I mean, you got to sit there and realize, like, okay, you've taken a profit, you moved up your stop to break even, and at this point, you're going to get stopped out for a scratch on the second half of your trade, which is fine, or it's going to reverse and go back up, which obviously is better. In this case, it did reverse and go back up, but I mean, I'll be honest with you. What happens is, I'd say 55 to 60% of the time in this case, you're going to get scratched out on that second one. Okay. The 1272 extension, very high probability. It's okay to take all your profits there if you want. If you want to see if you can get a little more of that, just realize it's about a 50-50 shot. So at this point, the main thing you want to do is protect your profits in case this trade goes south. Okay, so at least have a stop loss where if you get stopped out on that second half, it's at least a scratch trade, if not a little bit more cushion. All right, so one question too I found that people will ask is, especially the first couple of years of a trading journey can be kind of rough. I remember, Gosh, the first time I had a big loss when I was, my wife and we'd been married about a year, and I came home one day and said something like, it's kind of an off-the-cuff remark, and I said something like, yeah, I had a really bad day today. She's like, what's wrong? I was like, I lost like 30 grand in the markets. And that was, for me, it was a big loss at the time. And, I didn't think too much about it as a spouse. You want to be open with each other and stuff like that. And, I went to the room, changed, hopped in the shower, came out, and, my wife's like on the sofa, like bawling her eyes out, like, oh my God. And it's tough because it's like in fact, I just had the second edition of my book came out. It's Mastering the Trade, and she actually wrote, and it's funny because it's like on page 21 or 22 where she actually wrote like an article in there, like what's it like to live with a trader? Like what's it been like? And when I read it, I like laughed. I got a little nauseous. I was like, wow, I didn't know she was paying attention, all that time. But it was pretty interesting. And so a valid question comes up is like, can you actually make it as a trader? Because you hear that the success rates are pretty low. It's like 90% of traders, especially in like leveraged instruments, don't make it. And there literally is good news and bad news here. The good news is yes, trading is a very valid career path. I know traders from all walks of life that have found their groove, and they just, this is what they love and this is what they do, and they found a way to kind of overcome some of the psychological battles that were causing them to lose money. The bad news is it is one of the most difficult careers on the planet, and most people fail at it largely because of psychological issues. The real rub here is that in trading is difficult because it requires us to consistently do what is psychologically uncomfortable and unnatural, okay? And this never goes away no matter how long you've been doing this. What would be a definition of psychologically uncomfortable and unnatural? Apple breaks out to all-time new highs through $500 a share. How many people want to buy it then? How many people want to buy a new high versus waiting for the safe pullback to the 21-period moving average? Well, the people who wait for the pullback, that's the safe trade. They never get filled. The people who, in that case, buy the new high make money on it. But does that work every time? No, there's going to be a lot of false breakouts and everything like that too. So it's one of those where it is, the tough trade is typically the one, or the right trade is typically the one that's toughest to do. And you just got to remember that if the trade feels safe, guess what? It feels safe to everybody else too. And the trade that feels safe, the trade that's obvious, never works out. If there's a crystal clear head and shoulders pattern there, guess what? Everybody sees it. Everybody's lining up for the trade. That trade's going to fail most times. So just kind of remember that as you're going through, and that's that's what I found is that the obvious setups that seem like they're easy trades typically don't work out. There's a lot of money moving around out there. It's like I think it's like 80% of the movements in the market are controlled by 20 hedge funds. The 20 largest funds that are out there. They all see this stuff too. It's not a mystery. Okay, so I'm going to show you an example of a trade here that I did when I say that trading's not easy. And I remember this because I was packing up, I was doing a flight to Chicago, and I woke up and I had some calls on overnight on Apple and Baidu and Amazon. And Apple was doing great, Amazon and Baidu were not doing so great, but I had about an hour before my flight. So I'm sitting there trying to pack and I'm watching the quotes and stuff like that. And as you can see here, this is the same setup that we just talked about on MasterCard. And what I'm looking for is for Apple to take this momentum and get up to the 1272 extension, okay? And possibly the 1618, but realistically I was looking for the 1272 and I'll get out. So I set my limit orders in place, and I was packing. And as I'm watching along here, I can see I'm taking a hit on Baidu, Amazon's doing okay, and then Apple's, it's exploding up through here. It looks great. And then you can see here we're getting really, really close to my target here. And then what happens is that some report comes out and Apple starts to crater. Okay, and crater is a strong term. It went down about 2.5 points. And I choked. I got out of the market, and I've got to pack, I've got to do this, I don't want it to come back against me. Okay, the hard trade here would have been just to follow my plan and leave it on, because here we go, 30 minutes later, this is a 1-minute chart, it comes up and hits my target, right? Now I still made money on the trade, but again, it always comes back to doing the hard thing, following your plan. And the hard thing for me here, in this particular case, was staying in the trade, just because, it's because I got to go catch a flight. All these different things. There's always going to be distractions in your trading. Okay, I've got 3 young kids that are running around. There's always going to be distractions. But what I found is that the takeaway here is that if you get your strategy down, that you can actually make a lot of money trading by not being perfect. Okay? You don't have to have the perfect trade. I can count on one hand the number of trades I've done this year that I would call perfect trades. It's always something coming in. There's never the ideal entry. There's a good entry. Okay? And you just have to be prepared to do that. All right. So, we're actually doing pretty good on time. When does this talk end? Okay. All right. I can actually take a breath here. Okay. So, for those of you that trade options, just out of curiosity, how many of you have been trading the weekly options that have come out? Okay. Weekly options are fantastic because they have very high premium decay. And my rule of thumb in general is I'll buy weekly options, but I just won't hold them overnight. Okay. I don't mind day trading a weekly option, but in general, I'm looking to sell weekly options. Now, there's a couple of strategies that you can do with that. They're not included in this presentation. I'll just throw them out there for you. One of the things I found is that what a lot of people will come up and say, like, hey, John, I'm going to sell these weekly options on Friday because there's going to be premium decay over the weekend. Shh. Okay. There's no free lunch, okay? What happens is the market makers know that people want to sell these weekly options on Friday because they think there's going to be premium decay over the weekend. So the market makers actually push down the premium to what the option will be on Tuesday, and then everybody sells them on Friday, and then they don't understand why on Monday they don't make any money on it, okay? The strategy you can do with weekly options is you can actually sell them on Thursday and then buy them back on Friday, like the next day, when the market makers are pushing down the volatility, okay? And it works really good on spiders. You can do it as a credit spread, it's fine, or if you've got the margin, just sell them outright. Well, what's happening is when they first come out on Thursday, like that first hour that they're trading, that's when you want to sell them. By Friday afternoon, the market makers are pushing down the implied volatility for all the people that are coming in Friday to take advantage of the weekend. And so it's just one of those things where, again, where you got to kind of look if it's obvious out there, and I mean, guess what? The market makers know that, and they're going to take advantage of it. However, that is a strategy with weekly options you can do. Typically, you can even sell like a debit spread. You typically make 15 to 20% on that debit, and then you can close it back. And you can actually hold that over the weekend if you want, but there is that opportunity there, okay? Another one you can do is if you're doing, let's see, for weekly options, there's so many fun things you can do with them. One thing I actually like to do with weekly options, I call it kind of like a landlord play, where say that you've got a longer term position that you like, say an Amazon, a directional play, maybe it's, you've bought the option 2 months out. One thing I'll do is just sell an out of the money weekly, in this case, say I bought a deep in the money call, is every week to sell an out of the money call against it. Every week when it comes up. And most of the time, especially if you sell it at, I'm usually selling it about 2 strikes out of the money. Many times for weeks will go by where you just collect the entire premium on that. Or maybe you sell it for $4 and buy it back for $1. But typically, by the time you're halfway through that holding period, you've already paid for the option. Okay, so now it becomes kind of a free trade. So it's kind of, I call it the landlord play because it's like you've owned this piece of property and you're just selling, you're kind of renting it out for a week at a time. And of course, sometimes the stock may just jump up and now the one that you sold's in the money, but you'll still make the spread on it, okay? So no big deal. The biggest thing you got to watch for there is if the price, if the price plummets. So that's a strategy that I like as well. Other useful things I found with weekly options is we were talking earlier about how, like say right before Apple earnings, how the implied volatility gets so high and that the at-the-money calls and the at-the-money puts are selling for $30, which is crazy. So what I like to do is before the day before earnings come out, like on a Google or an Apple or something like that, you'll see that like on Google we did this where the strike's $60 out of the money. You could sell a credit spread $60 out of the money for $1. Okay, you can't do that the day after earnings. The day after earnings, you couldn't get a penny for it. So what we would do on something like that is you could actually do an iron condor, like on Google, like $60 out of the money both ways. Now, what your bet is obviously is that the move after earnings is going to be less than $60. Okay, if it's over $60, you still have your risk-reward ratio in place. But we've done that, with Google, with Apple, and different things like that. So the nice thing about the weekly options is they actually kind of give you this window of opportunity to play earnings, to take advantage of premium selling. Just for the love of God, don't like say buy an out of the money weekly option like on Tuesday and hoping that it'll go higher. I mean, it's just the premium decay on it is literally, like if you own 10 out of the money call options on Apple, you'll lose about $700 a day in premium. Okay, so you just got to realize that you just got the tick going against you very, very much on those. No, okay, so what I was just talking about now, if you sell it, that's great. It's good because you're essentially making, so if you sell, like say, a credit sell put, okay, on Apple, you sell 10 of them, you're making $700 a day just in premium erosion. If you buy it, you're taking the hit on it. So you just got to be very, very careful when you're buying weekly options because they can really screw the pooch on you on that one. That's a technical term. Okay, sell on Thursday, buy back Friday. I kind of like the delta like 20s, right around there. I mean, you're looking at delta 20s. You can go 3, 4, 5 strikes out of the money like that. What I've also found, though, if you can get a little bit, especially if it's quiet, if the market's quieter, if you sell closer at the money, you'll get about. So if you sell out of the money like a delta 20, you'll get it's a decent little kicker. If it looks like the market's pretty range bound, especially that Thursday, I'll actually sell at the money, and then you usually get, like if you do a debit spread, you can usually get like 15 to 20% on the debit spread if you sell at the money. If you sell a little bit further out of the money, you're not going to get as much of a bang for the buck, but you're going to collect. It's more like 5 or 6% or something like that. Any other questions? Okay, so let's dive in. Okay, so. I always talk about the 3 types of technical analysis. You've got oscillators, trend following, and volatility. That's the only type of indicators that are out there, and none of them are magic or anything like that. It's just math. The one of those that's the most important, though, is volatility, and that's the squeeze that we looked at the beginning of this. But here's what this is the next setup I want to talk about. We talked about volatility, we talked about trending, but we didn't talk about the oscillators. And this is my favorite setup for doing weekly credit spreads, or actually it doesn't have to be weekly, any type of credit spreads. This happens to be a chart of Baidu. It's a daily chart. I will not do this on other time frames. I like doing this on daily charts. I won't do it on a 5-minute chart or an hourly chart or anything like that. But what you're looking for is you want 2 things. One, you want to move to the upper band. Now this is it's called a reversion to the mean band, but it's just like the Keltner channels. Okay, so the Keltner channels are set up as 13-period moving average and then a 1.5 times standard deviation or average true range. But what I'm looking for is that we actually slam into the upper band and we'll get an overbought RSI reading. Okay, and this is just your basic 9-period RSI. Okay, and then all I'm looking for is for this market to then revert back to the mean. Okay, in this case, that's an 8-point move in Baidu. Now, what's nice about this is that now you can do directionally if you want, but I prefer actually in this case just selling a credit spread, okay? And you're not actually even looking for the credit spread to expire worthless. In this case, you sell. I like to sell at the money. If it's a $5 spread, I typically like to get half the distance of the spread, so $2.50, give or take. And then typically if it reverts back, you can, if you're close enough to expiration, you want to let it expire worthless, it's great. The big problem on credit spreads is that at some point you get to where you sold it for $2.50 and now it's at 50 cents. Well, now you're trying to risk $4.50 to make 50 cents. Okay, there are times when those credit spreads, when they're so close to expiring worthless, just explode against you the next day. So typically on something like this, we're looking to sell it at $2.50, maybe buy it back at 50 cents and make $2. Okay, it's a very high probability, very consistent play, even in a situation like this when it overshoots. Okay, it overshoots like this, you sell it for $2.50 and then it's like, wow. Well, the spread's still in place, so it's not like you're getting completely hammered here. It's like going, in this case, yeah, the stock moved up $6 against you, but your position's like $1 against you, okay? And then here we come back down, we're back to the mean. Remember that, okay? Yes?
65 to 35, or what also?
Yes, yeah, so, yeah, good question. So 9-period RSI, Overbought is 65, oversold is 35. All right. And what I was talking about earlier is why it's critical to understand when something like a squeeze is taking place, because as we saw earlier, we saw those charts of Apple and Priceline. When that squeeze is taking place and the energy is released and those markets just explode higher, this strategy does not work in that situation, okay? So the main thing with this is that you want to look at a market that does not have a squeeze in place on it, okay? You want to look at something where there is no volatility squeeze going on in a market. You're just going to do this during what I call normal market action, okay? And then for a stop loss, if you're going to do this directionally, what you can do is just put down a 14-period average true range, and then you'll come over here and say, like, okay, at this point for Baidu, the average true range is $8. So this means that it could go against you $8, but the chances are high that it won't go beyond that. Now, what's nice about this is if you're selling a credit spread, that's not a big deal. That means the credit spread will go against you depending how much time you've got, maybe $1, $1.50. If you do directionally, you just want to make sure that you're outside that range. And you can see here, it spiked up through that range, but quickly snapped back, okay? But it's the biggest thing a lot of times what I've seen is people will do these trades, but then they use too tight a stop, okay? These are high probability trades, but if you go in there and you're nervous about it and you use a big position and you've got a really tight stop, the chances are very high that you're going to get stopped out, okay? I would rather see you use smaller positions, use wider stops, and let the trade work itself out, okay? We've done studies with this, and we found that the harder you stare at your screen actually has zero impact on what you want the market to do. So you place your trade, you give it room, and then you go outside and mow the lawn, okay, or do something else, because watching the trade is not going to help it. And what will happen a lot of times is people will watch the trade, they're going to get that unblinking stare, and then they're going to start doing some stupid stuff. And when I say they, I mean everybody. I'm not smarter when I'm in a trade. Nobody is smarter once they're in a trade. But there are tricks to that. If you know that when you're in a trade, you start, freaking out and looking at it tick by tick, the trick is, 1, cut your position size in half. 2, place a stop loss. 3, get the hell away from your computer. And you'll be amazed. I mean, actually, that was an experiment that I did where I would do grain trades. I would place a stop with an open target, okay, and then I'd go to lunch, and I'd come back 10 minutes before the grain close. Either I was stopped out, or the market had some fantastic move that I caught every bit of. And I knew without a doubt that had I been there, I would have, in that positive trade, I wouldn't have caught the whole move. I'd have been like, wow, I'm up 5 cents. I need to take this profit. So just remember that. Just control your risk and then let the market do what it's going to do. It helps a lot. Okay. So here's an example of Amazon. So Amazon here has this fantastic move all the way from $200 up to $245, almost straight up. But at this point, guess what? It's time to sell a call credit spread, meaning you're looking for a reversion to the mean. And honestly, on something like this here, I'd feel more comfortable doing a call credit spread than a directional put just because the stock is so strong. So here's a screenshot of it. You can see here, we sold the so if you've never sold a credit spread, all you're doing, it's like, you hear that in this case, it's selling a naked call, and then you're buying another call outside of it as your stop loss. And that's all it is. So sold 100 of the 240s, bought 100 of the 245s for protection. And then what you want to see, obviously, is that the one that you sold is making money. And if the one that you bought is losing money, that's what's supposed to happen, and then you keep the difference. So in this case, we sold it for $2.25. So the max profit on the trade would be $2.25 per contract with 100 lots. That's $22,500. And then the max loss would be $2.75 per contract, or $275 per contract. And so you just manage it that way. And again, on these trades, it's very rare that I actually let it expire worthless. It's great when they do, but when you get to the point where the trade's to 20 cents, and now you're risking 20-cent profit against a $4.80 loss, the math doesn't make sense. The exception is if it's like 4 and 5 strikes away from from your break-even point, then okay, fine. But I mean, you guys, if you've been trading like Apple or Google, a couple weeks ago, Google dropped from like $629 to $600 on expiration day. if you had like a 610 call credit spit on that day and you're like, wow, it's going to expire worthless, you got hammered. Okay, so if you're down and you can take it off for a nickel or 10 cents, just take it off. It's like, people say, oh, I got to pay the commission on it. That's better than getting stopped out on the trade on some crazy move. Okay. Okay. We talked about that. Okay, so here's the last strategy that I like to do. This is what I call the IV crush. I was trying to think of a cool acronym for it, but I couldn't come up with one. BNVIC, I think that's a Czech word for something, I'm not sure. But essentially what you're doing is when I wake up in the morning, you can just turn on like CNBC or look at Yahoo News or whatever, and you're just looking for stocks that have bad news, okay? Earnings is good, but typically about any bad news is good except for like an SEC investigation. You don't want to do that one. But the reason I like this is that the markets are very efficient in that they price in all this bad news before the open. Okay, the markets trade, a classic one was always when Steve Jobs was sick. And even when Steve Jobs passed away, the same thing happened. What happens is people panic. Apple was down $20 or $30. Well, guess what? When it opens, it already opens at the price where they priced in all the news. Okay, in the very first few minutes of trading, the implied volatility of the at-the-money puts explodes. Okay. And what you want to do is you want to sell those to people who are panicking. Because there's going to be a lot of people. There'll be people at Apple, okay, who are probably, they're buying puts to hedge against, their stock. There'll be lots of people who are panicking because they're thinking, wow, what if Apple goes down $100? I bought it at 100. I don't want to take these capital gains. I need to buy puts. They panic and they buy puts at the open, and that's what drives the implied volatility so high. So what you want to do is you want to become a market maker, and you want to help them out and provide them liquidity and sell the puts to them. Now, so here's what happens. So here's an example of Baidu. This is a 5-minute chart. So Baidu closed at $430. It opens the next day. Now this is a line chart. So it actually opened the next day down at $370. So we sold the at-the-money puts, the $370 puts at the open, for $10. Now what happens here is Baidu starts to trade sideways in the first 10 minutes. What does the put do? It immediately gets cut by a third. Okay? That's that implied volatility just getting crushed. Now, the beauty of this is that if Baidu had traded dead sideways all day, the move would have been about the same. Baidu kind of traded sideways to up, but you can see these puts that you sold at 10, you could buy them back at $4 later in the day. But what happens like this is that, again, when the stock opens up, the bad news is already priced in, and so there'll be some fluctuations like that, but what you're doing is you're getting that explosion of volatility, the people that are panicking, that's what you want to sell into, and then you just buy it back when things quiet down. Now, what you want to be careful of is on something like this too, is you can also, of course, just sell it as you can sell it as a spread. So you can, of course, sell the at-the-money and then buy one out just for some protection. Because, you do want to be careful in case you get something that just goes. If you're selling something naked like this and it just keeps going against you, it could get pretty scary pretty fast. Yes?
That's actually what I was going to ask. The expression, you don't want to catch a falling knife like the
right.
oil spill. That just kept going down for a while. So,
right.
So you'd actually sell a spread on that versus just the naked.
Yeah, so that's a good question. So the question is that, you don't want to catch a falling knife. So for example, on BP. So BP is a good example. I've kind of looked at it as more, some good examples are, it's like,
Apple's a good example. A good company, but it's just
bad news for a good company. Yeah, the oil spill was kind of an interesting one. In fact, I don't think we did one on that, but I have done it on companies before where, it gaps down and you're just like, wow, it keeps going. If you sell a spread, a lot of times you'll be okay because the two will kind of even themselves out. If it's like a stock that's like $60 and below, and say it's like, I remember like Amgen gapped down like $4. All right, so we'll just sell it naked, watch it really closely. If it looks like it's going to keep going down, either buy it back or buy some protection. But there's a lot of times when it's just like it's priced in, you get some wiggle, and then things settle down. You can sell it for $1, buy it back for 60 cents, kind of a thing. Okay. Any other questions on that? Okay. Yeah. Okay. Yeah. So, a good question is, if you're doing this with a spread, is there enough juice out there? Essentially, if you do it, so if you're selling an at-the-money spread and you can get half the price of the spread, which is typically pretty easy in a situation like this, So you $5 wide, you sell it for $2.50. Generally, by the time things settle down, you'll be able to buy it back for like $1.20, $1.30, something like that. So it's the difference between like going like, okay, I'm going to grab $1.20 out of this versus selling something for 10 and buying back at $3. Something like this, yeah, doing this naked is very, it's like, okay, got to be a little careful there. But the other thing I'll do is also sell at the money, and instead of buying the next strike down, go down like 3 or 4 strikes. So at least you've and obviously you're watching that one very closely. And then if it looks like things are starting to settle up, great. Or if you need to add some more protection, but the first 3 or 4 minutes can be pretty hairy, but then things settle down fairly quickly.
Mr. Carter?
Yes.
Does this apply to a bad earnings report?
Yes, absolutely. It applies to bad earnings, very much so. Now, the thing is, I found that this does not work on the upside. So it's always bad news. Good news, it's one of those things because people panic on down moves because down moves can happen so much faster than up moves. But up moves, I tried it like twice, and I was 0 for 2, and that was good enough for me. Any other questions on that? Nope, good? Okay. All right. So, okay, good timing here. So 2 things. One, you got the card here. We're going to do a drawing here real quick. We'll collect those. And then I guess, Christine, how do you want to do it? Just have them pass them to the middle? Yeah, pass them toward the aisle, and they'll collect them, and we'll do the drawing. So for those of you that are interested in more options information, we do have a website that's dedicated specifically to options. It's called Simpler Options. And we do on this where we do actually have a nightly video where we talk about the different strategies that we're looking at. We also have a portfolio where we try to specifically track some of the trades that we're doing. I believe you have a form. What does a form say? A form on your seat. Okay, perfect. So that sounds like a good deal. A 10-year trial. So if you want to try out the site, essentially it's you can sign up on this today. We don't actually have a free trial on the site. We like to keep people who are actually focused on there. But you can try it for 30 days for $7. What I would encourage you to do is to do it, and for $7 you can get all the questions answered that to make sure that you know it. The goal with the site though is that if once you know the strategies, you don't need us anymore, great, go do them yourself. That's fine. The reason people stick around is that they like the community. So it's just options traders. There's a discussion forum. There's a live trading room and stuff like that. So if you're looking for a community, it's pretty good. But for $7, I was going to say I'd try anything for $7, but that's not true. But for $7, I think it's a pretty good deal. And yes.
Would it work because we still don't have a proprietary?
So good question on the indicators. So some of these indicators are actually, we've built, let's see, all the indicators that we have built for TradeStation, and we do share the charts in our room. If we have them on a couple of other platforms, but for the most part, it'd be something too where if you, in the chat room that we have where we share our charts, you'll actually see the charts that we're using. So what people have done is either they'll get TradeStation and get the indicators, or they'll just sit there and say, you know what, I like my broker, but I can look at your charts and see the signals, or just get used to the strategies and you can actually, try to figure out, that's the main thing is just, options trading is one of those things that it's not too difficult once you know some of the basics. And that's the main thing is once you learn the basics, you can sit there and go, okay, well, I'm just going to use this moving average and now I can do this setup. And that's fine too.